We're jumping straight into IREN today. Everyone is watching the price action, but the real story is the race to hit $3.4 billion in recurring revenue by the end of this year.
Exactly. You're tuned into the Easy Money Show where we make sense of the market's biggest moves. I'm glad you're with us.
Yeah, and please make sure to subscribe and hit the like button if you want to keep following these breakdowns, because today, Friday, February 27th, 2026, we are really aiming to, simplify all this crazy noise around IREN's transition from crypto to high-performance computing.
Right, because the noise is deafening right now. I mean, you look at the stock drop.
9 to 11%.
Right, 9 to 11% right after the February 5th earnings release. And investors are just panicking. But honestly, they're missing the forest for the trees here.
They really are. People see the ticker, they remember the old IREN Energy days, and they just think, Bitcoin miner. But this is not just a Bitcoin miner anymore.
Not at all.
It's this massive infrastructure play. They are actively trying to transform into a full-blown hyperscaler partner.
And it is arguably one of the most complex corporate pivots we've seen in a very long time. It's an identity crisis, but one with billions of dollars on the line.
So let's get into the bull case first. Why smart money is actually looking past this current volatility. Let's start with the sheer scale of the growth story.
Yeah, if you look at their fiscal year 2025 revenue, it came in at $501 million.
Which is a 167.7% jump year over year. That is a staggering number.
It is staggering. But we need to clarify exactly why that happened, because it wasn't just one thing. It was actually the result of their initial, very aggressive expansion into Bitcoin mining, combined with the very early days of their AI infrastructure build-out.
Right, so they basically used the crypto boom to fund the foundation of this AI pivot.
Exactly. They were firing on all cylinders in crypto just as the market heated up.
But every miner is trying to pivot right now, right?
Yeah.
It's the buzzword of the decade. What makes IREN different is what the bulls call the moat.
Yes. Owned energy.
Exactly. While competitors, companies like CoreWeave might have to rely heavily on third parties or lease space, IREN actually owns its energy assets. They own gigawatt-scale data center infrastructure.
And we have to emphasize how critical that is. To most people, power is just a commodity. You plug something into the wall and it works.
Right.
But in an AI world that is absolutely starving for power, owning the plug is the ultimate leverage. You can't just call up a utility company and ask for a gigawatt of power for your new AI chips. It takes years to build substations and get regulatory approvals.
So they aren't just a tenant begging for electricity. They are the landlord holding the keys to the power grid.
Perfectly said. And that landlord leverage is exactly what led to the Microsoft deal.
Oh man, we have to unpack this Microsoft deal. This is the centerpiece.
It really is. We are talking about fixed-rate contracts, specifically a massive $9.7 billion deal with Microsoft.
$9.7 billion
Yeah.
with a B.
With a B. And that brings us to their ultimate target. Management is aiming for $3.4 billion in annualized recurring revenue by the end of 2026.
ARR. That is the magic acronym here.
Because it's predictable. It's not like Bitcoin, where the price fluctuates wildly every single day. AI infrastructure contracts provide steady, boring, beautiful cash flow.
But talk is cheap, and silicon is incredibly expensive. To hit that $3.4 billion ARR, they have to buy the chips. And we all know NVIDIA GPUs are not exactly on clearance right now.
No, they are not. But this is where IREN's financial muscle comes into play. As of January 31st, 2026, they are sitting on roughly $2.8 billion in cash.
There's a massive war chest.
It is. And on top of that, they secured a new $3.6 billion credit facility that is specifically designed just to purchase GPUs.
Right, so they have the money to actually fulfill these contracts. They have the capital to buy the 140,000 GPUs they need. So, on paper, the bull case sounds airtight. They have the power, they have the Microsoft contract, they have the cash and the credit to buy the chips.
Which naturally leads us to the bear case. Because if it were truly a guaranteed home run, the stock wouldn't have plummeted after earnings.
Right. Let's talk about the execution risk and the cash burn, because the reality check hit hard on February 5th with that Q2 2026 breakdown.
It was an ugly quarter. Revenue came in at $184.7 million. They completely missed estimates.
And it dropped 23% from the previous quarter. That stings when you are pitching a hypergrowth story.
It definitely stings. But you have to ask why. And the answer is that they are still fundamentally tied to Bitcoin prices and mining difficulty. Both of those factors created massive headwinds in Q2.
So they are caught in this awkward transition phase. They're trying to build the AI city of the future, but their paycheck is still coming from the volatile crypto mine next door.
And that paycheck was light this quarter, which brings us to the profitability concerns. They swung to a net loss of $155.4 million.
Now, to be fair, much of that was non-cash charges.
True. But the headline number terrifies retail investors, and the operating margin collapse is very real. It went down to negative 63%.
Negative 63%.
Right, due to incredibly heavy spending on the transition.
Which brings us to the most alarming metric for the bears, the free cash flow. It was negative $468 million in Q2 alone.
That is a terrifying burn rate.
It's nearly $500 million flowing out the door in 90 days. Because their CapEx, their capital expenditures, they spent nearly $540 million in just one quarter building out these data centers.
And this is the core risk. They are burning cash incredibly fast. The risk is that if these AI contracts get delayed even by a few months, or if the execution slows down, they are left holding a very empty bag.
Because they've taken on debt to do this. The debt-to-equity ratio rose to 1.80. They have massive overhead now.
Exactly. And the market sentiment reflects this skepticism completely. You see bearish news highlighting things like, still no reason to upgrade.
Yeah, and analysts are openly worrying about them becoming just another neocloud.
Right, it's an identity crisis. Are they a miner or an AI firm? The market is currently punishing them when Bitcoin falls, but it's also punishing them for the heavy capital expenditures required to actually become an AI firm.
They can't win right now. They're stuck in the middle.
So it all comes down to execution over the next 30 to 90 days. That's what investors need to watch.
Okay, let's detail that. What are the specific triggers that will determine if the bull or the bear case actually wins out here?
First and foremost is the ARR progress report. Everyone is looking toward the Q3 fiscal year 2026 earnings, which are expected around May.
But honestly, you shouldn't even wait for May. You need to be reading the monthly investor updates leading up to it.
Absolutely. The key metric in those monthly updates is simple. Are they deploying those 140,000 GPUs on schedule?
Right, because if they say supply chain delay, the stock is going to get hammered again.
It will. Now, the second thing to watch is the institutional flow, the whales.
The technical analysts have been going crazy over this. There's been a massive options frenzy and whale alerts recently.
Because big money is positioning for something, they are expecting extreme volatility.
They're waiting for an announcement on the Microsoft contract ramp-up.
Exactly. If IREN drops a press release saying that the first major phase of that $9.7 billion deal is live and generating cash, that's the catalyst the whales are hunting for.
But we also have to keep our eyes on the macro factors.
Yes, Bitcoin price is still a major factor. Since they haven't fully exited mining, a crash in crypto still deeply hurts their bottom line.
And interest rates. We talked about that $3.6 billion credit facility.
Yeah.
When you borrow billions to buy hardware, the cost of capital matters immensely.
Rate stability is absolutely crucial for them right now. If rates spike, their debt servicing costs explode.
Okay, so let's summarize all of this into a closing thought. Give me the elevator pitch for IREN right now.
The elevator pitch is that you are looking at a company trading at roughly 3.2 times forward revenue. That is a low multiple typically assigned to a miner.
But they are trying to re-rate into an AI multiple.
Right. If they successfully transition, that multiple could expand to 10 or 15 times revenue. It's a massive re-rating opportunity.
But the final provocation here, the thing you as an investor need to decide for yourself, is whether that Q2 earnings miss was just a transitional stumbling block.
Just a bump in the road.
Exactly. Or if it was a giant red flag that this pivot is fundamentally harder and more expensive than it looks.
And you have to keep your investment horizon in mind. This is a multi-year hold into the 2026 ARR inflection point. You are betting on the destination, not the current construction zone.
Well said. All right, that is the lowdown on IREN today. Thank you for joining us for this deep dive. Don't forget to subscribe and hit that like button, and we will catch you on the next one.